Hey everyone, David Coe with the Real Estate Group. Hey, we just got back from a really fantastic meeting in Las Vegas for Family Reunion, which is Keller Williams' annual conference. And at the conference, Gary Keller went through kind of their vision for 2024 in the real estate market. So I have a couple of select slides from the vision speech that Gary made that I'm going to walk through with you today here to kind of give you a good overview of where we are in 2024 in the real estate market. So first thing we're going to go through is just some of the raw numbers that are driving the market. Probably the biggest thing that we've been seeing is just a lack of transactional volume. On this slide right here, this is the actual number of homes in the U.S. In millions of actual transactions that have happened. And you can see that in 2023, there was a significant drop as interest rates rose. The actual number of transactions came down. We finished with about 4.1 million homes sold in 2023. And we're pretty much projecting the same thing for 2024, about 4.3 million. So, there was not going to be a huge number of transactions increasing, mostly because interest rates will stay relatively flat, which we'll cover here in a few slides. So looking at it at a monthly level, the numbers in purple or fuchsia, whatever color that is from 2022, and the numbers in green are in 2023. And you can see that starting in January of 2022, the pace of sales that we were on was slowly decreasing as rates started to go up. And then in 2023, it basically just stayed flat the whole year. So normally we would see kind of an increase of sales volume in June, July, August, September that never really materialized last year. And we aren't projecting much of an increase in this year either. This was a key slide for me. This is looking at home prices on kind of the trend line around the country. And, basically the long-term trend in real estate for primary residences is about 4% of an increase year over year. And you can see back here in 2004, 2005, 2006, prices got way above the trend line, almost 24% above where our average trend line was, which was part of the Great Recession that happened in 2009. And you can see how long it took for home prices to climb up again above this trend line. Then all of a sudden COVID hit and everyone started buying their crazy COVID pads. Rates were down super low, and you can see that there was these big increases in home prices, average home prices, that now seems to have stabilized. So when we look at 2022, 2023, we're about 9% above where the trend line is. And we are projecting a increase in prices in 2024, but not that much. So I think as the time goes on, we're going to finally, prices will probably level out. And I say within the next, few years, we'll probably kind of regress back to the mean, so to speak, and prices will start to look more like they did in the 90s where, we'll be back on that 4% trend line in home appreciation. This actually is I think it's an interesting chart because this is looking at the home appreciation percentages over, really since 1990. And you can see there's really only been 4 years in the last 35 years where home prices have been negative. And that was due to the Great Recession, in 2007 through 2011. For the most part, home prices have continued to climb. What you can also see is in 2022, we had these huge spikes because of what happened with COVID. Almost 18% in 2021 and another 10% in 2022. But it looks like we're kind of starting on a year-over-year basis to calm down and level out, although there doesn't seem to be a big drop in the future anytime soon. This is another look going even further back to 1954 on home prices. And you can see how consistent it's been where home prices tend to appreciate positively year over year. There have been a couple of times in history. In 1959, the Fed Reserve raised rates. prices dropped. In 1973, there was an oil crisis. Prices dropped. Severe recession. And 1982, Fed raised rates to the all-time high, and there really wasn't much of a drop. It just kind of, the market flattened out. In 1991, we had the savings and loan crisis. Prices dropped about 2%. You can see the housing bubble that we had in 2005. And then, this was based on some really shoddy lending criteria. And then, of course, we had the Great Recession, 12% in 2009. And, I think it's interesting when you look at this, everyone thinks that, hey, housing prices are high, they're going to crash again. But rarely do prices crash double digits, other than, this really, it was a banking recession, right, that caused this severe drop in 2009. And a lot of that was due to this huge bubble in 2005. Now, we did have this huge bubble in March of 2022 as well. This was the pandemic housing boom where everyone was, again, looking to buy something new, working remotely. But you can see how quickly prices have kind of come back down to the norm, although, we are starting to see some price appreciation again this year and last year, mostly just due to the fact that we have a lack of supply. So looking at inventory rates, I think this is really important. The dotted line here is what a balanced market is considered to be from a month supply situation. So, a good healthy market, you've got about 6 months supply. You can see really since 2012, we have been under this 6 month time frame. And because of that, we have had a lot of appreciation. 6% was the average between 2012 through 2019. And then, of course, we had this crazy bump during the pandemic. But even today, we are still down at a very low supply of homes, only about 3.1 months worth of homes, well below what's considered of average market. We're definitely more in a seller's market, although there are deals to be found out there if you know where to look. Mortgage rates has been a critical driving factor on all of this. You can see as of the end of 2023, we got down to about 6.81%, which, when we look historically all the way back to 1972, the average, historical average is right around 7.74%. So we're still below that. And then, even if you take out the 1980s where there was some crazy interest rates that got up to 16%, our average has been about 6%. So we're starting to kind of, get back to a more average interest rate level. However, so many people have gotten used to these sub, 3-4% rates that we've had since the Great Recession where, interest rates have been artificially low. And more than likely for the next couple of months, we're going to stay right around, somewhere in the sixes for 2024. We're really not projecting, to maybe get back down into the fives until 2025. So looking at things monthly, you can see how things spiked in October of 2022 and then again in October of 2023. Things have come down since then, and we're projecting interest rates will probably stay in the sixes for most of this year and may not see the fives until either the end of this year, after the election, or maybe into 2025. This was an interesting thing. This is looking at a 30-year mortgage rate versus the 10-year treasury and the spread. It's pretty rare where the spread is more, the average is, which is the green dotted line, is about 1.74%, where interest rates sit on top of where the 10-year treasury is. It's, the highest it's ever been at 2.85%. And a lot of that is because banks right now are keeping their rates higher, knowing that most people are going to end up refinancing those rates in the next couple of years. So banks are still lending, but their rates are staying higher than where they have been historically compared to the 10-year treasury, just because, most lenders are correctly assuming that most of these mortgages are going to get refinanced in the next few years. When we look at affordability, you can see that actual affordability is starting to increase, and this has a direct correlation because of the high interest rates. So the orange line here or the yellow line here is the percentage of someone's income that they're spending on their principal and their interest. And in 2023, that hit 32%. So you've got higher home prices that have not come down, and you've got high interest rates. So you can see there's been a significant increase in the amount of someone's salary or income they're having to pay. This is up to 32%, which is, in 2006, we hit 32%, and then we had a big decline. In 1981, it hit 49%, and then we had a huge decline. Historically, we like to be within, from the last, modern history, right around 20%. If you look long term, it's been 27%. So it is harder, for people to afford to buy a home. And that is one of the things that's actually suppressing demand. However, demand is being suppressed by high interest rates, probably even less than it's actually suppressing supply, right? A lot of people are locked into rates that are below 4%. And just don't want to have to go out and take on a new loan. So they're just sitting tight and waiting for affordability to improve. I think affordability will probably get improved more by a decrease in interest rate versus a decrease in actual home values, just because of the lack of transactions that we're having and the lack of supply. All right, so let's go on and take a quick look at the U.S. economy. Looking at GDP, the economy is staying pretty strong. Obviously we had a huge decrease in 2020. This was right when the pandemic hit. Supply chain issues. We had about a 2% drop. And then a huge overcorrection in 2021. And we've seemed to kind of settle right around back to where is the mean, which, 2% is generally where we like to see GDP. For 2023, we ended just a little bit above that. Unemployment is very, very low. Other than the late 1960s, where it hit 3.5%, we are still down at 3.6%. And quite frankly, we could use a little bit of higher unemployment. I think that's one of the things that the Fed is using as a reason to keep the Fed rates where they are, is because of how low unemployment is. So, it doesn't seem to be any huge increase happening in unemployment unless we do end up having a fairly major recession. The personal savings rate is something that's critical. People that are looking to save money to buy a house. We hit a really all-time high in 2021. A lot of that was, PPP loans and just money that the government was handing out to people to help them survive the pandemic. But then very, very quickly, we got back to spending, which is why inflation went crazy. In 2023, it got down to 4.5%, and all of a sudden now things are starting to increase here a little bit in 2023. Historically, saving about 8% of your income is a good place to be. But, in recent years, 5% of your income is a good amount of money or on average that people save. And we have been well below that. If you take out 2021 and all of the money that people were just kind of saving that they were getting from the government. Inflation, this is the critical slide. It hit 6.4%. Well, actually, this is the orange line is the CPI, which includes energy and food. The blue line is the core CPI, which excludes energy and food, which can tend to have a little more volatility in them. And, we are slowly starting to come back down to that 2% rate that everyone talks about. But we're not really projected to hit that until 2025. Looking right now, we ended 2023 at about 3.9 or 3.4% in both, core and regular CPI. And while they are trending in the right direction, there's still probably another year before we hit that magical 2% line that the Fed is looking for. This slide was interesting. When you think about inflation and they start to cut it out, things like cars and technology have actually been fairly low. And in fact, we've been in a deflationary environment when we think about computers and technology, as the cost of production comes down. Housing's been pretty, while prices are higher, they've actually been below average hourly wages. Where a lot of our inflation is coming from is from college tuition and hospital services. Look at hospital services. The cost of being sick has gone up dramatically since 2000, and really these items in purple are what's driving our current inflation. Consumer sentiment is actually growing. I think we're finally starting to see with inflation coming down. But you can see back in May of 2022 it hit a low of 50. This is an index number. This is when inflation was really starting to peak, but, it's climbed back up. Not quite as high as it was back in February 2020, pre-pandemic, but it is on the rise. And I think as inflation continues to cool, we'll see consumer sentiment continue to increase. All right. And then lastly, a couple of things to look at, from a real estate market, the percentage of listings with price drops, we're still looking at about, over the last year, we've had a lot of homes that have had price drops. And I think it's important, brand new homes or homes that are in great condition in great neighborhoods, we've actually been seeing multiple offers. But homes that have been on the market for a long time, homes that need a little love, have some, deferred maintenance in them, there have been price drops, and you are able to look at getting a deal. So if you're willing to put in a little work into a home, there are deals to be had. And, even in, December of last year, about a third of all homes that were sold had some kind of price drop in them. New listings, and looking at 2022 and 2023, you can see we only had 4.8 million new listings. And historically, we get this jump in July, kind of May, June, July in the summertime where new listings happen. You can see that happen in 2022. That just never really materialized in 2023. It's also right when rates were starting to climb to get into the 8s. And a lot of people had, we call the golden handcuffs, and they were just, even maybe if their housing situation wasn't ideal, the thought of having to go get a new loan at those higher rates, was just unaffordable. So most people just sat tight, and actually, we had a lack of inventory hitting the markets, which is probably why prices have stayed stable. Whatever demand is there right now, we just don't have a lot of homes for people to take a look at. Distress sales, this is what drove the 2008, 9, 10, 11. You can see that there we had, almost 30% of the market, actually almost 40% of the market in 2008 were distress sales, either foreclosures or short sales. But since 2018 and, really the advent of Dodd-Frank, which was legislation put in after the Great Recession, we've doubled in 2023 versus 2022, but we're still at 2%. And the percentage of distressed sales is so negligible, it's not even broken out between foreclosures and short sales. So we don't have a lot of that distressed inventory that we had, after the 2006 and 2007 huge run-up. Same thing with underwater homes. A lot of people, with the rise in appreciation for the last 4 or 5 years, only 1.8% of all homes in the United States is actually underwater, which means the amount that they owe is more than how much the home is worth. That is significantly below what is the median historical average. Historical average is about 6%. Certainly in 2010, 2011, this was where people were getting crazy loans in 2005 and 2006. And then when prices dropped on the homes as much as we did, almost a quarter of all homes were underwater. But that has not been the case and is not the case right now. Credit conditions have actually been fairly good. If you can get a loan, banks are lending. So if you have the desire, if you've got the income, if you can afford the payments, banks are lending. That was not the case in 2008, 2009. A lot of banks shut down because they had so many underwater properties. They didn't want to take the risk of taking on new mortgages. And then, of course, that spiked in 2020, quarter two, because of COVID. Everyone was just kind of waiting to see. But since then, the banks have been willing to lend. They're tightening up a little bit, but I think a lot of that's just due to rates going up more so than, their lack of desire to lend. New home starts. This is something that's really important. When you don't have a lot of sellers looking to put their homes on the market, new construction can kind of help fill that gap. On average, we need to build about 1 million homes, which is what this green dotted line signifies. And you can see since 2008, we have been significantly under that. We finally hit it in 2021, but now with rates going up, builders are also kind of waiting to see what happens with interest rates before they go through and start doing more home starts. Which will, again, further decrease the amount of available homes that buyers have. It's going to keep the day supply low and keep prices fairly steady and consistent without any significant price drops. And then lastly, new home sales. Historically, we sell about 650,000 new home sales around the country in the year. And that's been where a lot of the sales have been. A lot of homeowners have not been putting their homes on the market because they have such low rates. So we've been pretty much on average selling new home sales, which is something that, my team specializes in. We've certainly seen that. So some risks going through 2024, ineffectual governance, being able to actually make decisions and make progress. That's been something that we've been dealing with for the last few years anyway. Being in an election year, more than likely nothing will happen as neither side wants to give or take. Obviously, we still have some global conflicts that we're dealing with that we see as economic risk moving forward. Probably the biggest one, I think, are financial risks stemming from commercial real estate. So this is something that we're keeping an eye on, especially with multifamily and retail and office, where there's a lot of debt that is getting ready to reset. And with interest rates being as high as they are, there's definitely some trouble coming in the commercial real estate sector. And then natural disasters and severe weather events. We're seeing more and more of these, fires and snow and flooding as we kind of get extreme weather conditions, which could have an impact on real estate as, large number of homes are taken off the market, because of these weather events. So overall, the message for Family Reunion was, keep your head down, grind in 2024. There is business to be had, but not as much as there has been historically. But survive to 25 is kind of the mantra that we have. So hopefully you found this information interesting. If you would like to have a further conversation about any of this information, or more importantly, how it affects you, please let myself or someone from the team know. We'd love to sit down and chat with you. So David Coe with the Co Real Estate Group, thanks for making it through the entire video, and hope to talk to you soon.